Good morning, everyone. This is Ben Ryan, and welcome to the Hedgeye Morning Macro Call for Tuesday, October 28th, 2014. Before I hand the call over to Keith, I'll hit on small changes in asset allocation day over day. We took our cash position up to 65% from 64%, reduced fixed income exposure to 27% from 28% yesterday. Commodity and FX exposure was held flat at 4%. International equity and U.S. equities exposure at 0%. With that, take it away, Keith.
Those zeros, I tell you, crazy guys. Top three things in my notebook this morning. Number one, U.S. S&P sectors, number one. Number two, the price of copper. And number three, looking at all of Europe. So first on S&P sectors, the reason why I want to call this out, we spent a lot of time with institutional investors in Boston yesterday. And again, one of the main topics for equity portfolio managers is, do I keep buying healthcare here? Do I keep selling energy here? The reason why, obviously, is yesterday you had a down 2.1% move in the energy sector, and healthcare was up again. And that's after healthcare being up again last week, up 6.6%, and up big time for the year to date, up 18% for the year to date. So what this is called is sector variance. And again, when variance rises, that means that the complexion of market risk is rising as volatility does. So again, sector variance rising is a clean-cut signal of more volatility to come. And yes, we'd stay with healthcare, even though it's getting more expensive. Now, the second thing would be copper. Copper's up a lot, obviously, because China had its first up day in the last 6. So again, Chinese stocks go up, copper goes up. What do you do with that? Short copper. Okay, short copper, short old China. Again, there's a lot of setups here in macro to play. What we're waiting for is immediate term trade over bought signals in things like copper or anything that trades really. Copper is immediate term trade over bought anything north of 309 and has immediate term downside to 290. Now finally, Europe, again, you get the sell-off yesterday, then you get the bounce. And then you get the sell-off, then you get the bounce. And then what do you have in Europe? You have deflation. So again, after everything that Draghi thinks he can do or possibly do or communicate, the equity market doesn't care. Now again, there's a super secret thing that's happening in Europe. It's slowing. So again, we'd reiterate Europe slowing, which is a Q4 macro theme at Hedgeye, and we would short places that are socialist in nature, like France, on the bounce. EWQ is ETF there. And those are your top three things. Now, for those of you that are dialing into this for the first time, what I like to go through is everything in my notebook, which leads you to the top three things, because everything in macro is nonlinear and eventually graduates to being something that you should care about. Now, again, I'll just go through risk ranges, levels, and again, directional views that we have on everything that's happening out there, and I'll do this relatively quickly. S&P risk range on an immediate term trade basis. So again, that would be today. 1841 is support. People are looking at the future saying, what? 1841? Yeah, that would be a probable decline to 1841. Whether it happens today, tomorrow, the next day, you wouldn't get the message from us saying that we consider that improbable. Now, momentum people, or people that like to chase momentum on the upside, don't like that number, and I don't particularly care about that. 1981 is resistance. So again, if you're looking at risk versus reward, there's 6% downside in the S&P from where they closed the cash yesterday and 1% up. So more risk than reward for the it's the fifth consecutive day. Now, if you look at the risk range on an immediate term basis in the Russell 2000, you have no support to 1057. Now, viewers will note that that's a long way from where they closed the Russell yesterday, and no, the Russell still doesn't look good, and no, we haven't liked it really since January. So again, we'd reiterate the short call on the Russell on the bounce with immediate term trade resistance at 1127. So again, if you see 1127, that's a good spot to buy puts. It's a good spot to short the Russell. It's a good spot to generally just get bearish. So that's what I think about that. Our range on a 3-day basis, and again, if I blow that out a little bit on the S&P in particular, I get 153 points wide is my risk range. 153 points wide. 3 months ago, the risk range was toggling between 30, 40 points wide. Now it's 153 points wide. So good luck with that. Again, that's a leading indicator of what? Rising volatility, which is born out of the same thing that variance is. So again, the regime change or the phase transition that markets have gone through in the last 3 months is notable and has changed the game for anyone who's paying attention. Volatility on the VIX, if you're trying to trade front month VIX, the risk range there is wicked wide. It's 1434 is support, 2805 is resistance. Do I have 2805, Mr. Ryan? 2805, how do you like that? Now, if we wake up tomorrow morning to 28 on the VIX, how are you going to be feeling about being long things that don't look like Twitter this morning? Now, again, that's going to be a big problem because momentum guys are going to get hung out to dry, as they have many times, in saying that volatility is going to go back to 10. So again, 14 to 28, that's your risk range. Attempt, I wouldn't even say manage it. I'd say attempt to manage. It's not going to be easy to manage. Are you kidding me? Volume. Now, underneath the hood yesterday, the volume was down on really a kind of a nothing day. If you look at the S&P, it's like, oh, nothing happened. But if you look at the subsectors, again, energy down 2 and healthcare up a bit, you'd say, well, a lot happened. So again, people run portfolios. They don't run stocks. And again, that's the main takeaway there. And on the rallies, what we've typically seen is decelerating volume, whereas on the big kind of flush moves, we've seen accelerating volume. That's because this market continues to be a liquidity trap. A liquidity trap, just for those of you who don't know what that is something you can't get out of. Sectors, again, just to break it down, the sectors that we like, there's only 3, and I'd rank them in this order: healthcare, consumer staples, and utilities. So again, those would be very slow growth or quad 4 type sectors. Quad 4 in our model is where you have both growth and inflation slowing at the same time. So you can't buy energy stocks, you can't buy anything related to commodities, maybe gold, which doesn't really look like a commodity to us right here and now. But again, healthcare, consumer staples, and utilities would be your huckleberries on the long side. With everything else on the short side, by the way, I'd be comfortable with that. Looking at the short side of Asia, interesting entry point here, re-entry point, whatever you want to call it, on the Nikkei. Nikkei signaling immediate-term trade overbought yesterday and starts to decline a little bit. So what I'd like to see here is a reversal in U.S. equities, and again, you'd be shorting things like Japanese and European stocks on that, which are right up at the top end of the risk range. At the top end of the range, you sell. At the low end of the range, you buy. If you call your local momentum monkey, they buy high trying to sell higher, and they freak out low. They're two very different styles, which is why we have a little bit of tweet fighting sometimes, and that is what it is. China up 2.1% last night. Like I said, first up day in 6, and does anybody care? I certainly do not. China continues to slow, so we'd reiterate that this morning. If you have to be in China, be long the new side of China and short the old stuff. Looking at Europe in terms of levels, I'll just give you immediate term trade overbought levels for the FTSE, the DAX, and the CAC, because again, at the overbought lines is where you want to be making short sales, and again, that's how we live in terms of the bear caving of it all. Looking at FTSE, immediate term trade overbought line of 64.83. Looking at the immediate term trade overbought line in the DAX of 91.64. Immediate term trade overbought line in the CAC 40, which is France, 42.09. 42.09. These numbers, when you write them down, they can be like sticky little critters, but they are what they are. They're called resistance within bearish trends, which is basically all of Europe, both fundamentally and quantitatively at this point. If you want to check in on Russia or Brazil, who are having big time problems, again, Russia's bounce is what, like 0.5% within a crash. Don't forget that Russia's stock market is down 25% for the year to date. Continues to crash, and again, the economic collapse in Russia, what are you going to do when you have that as oil continues to meander right where it is right here now? So just to hit on that, commodities. Oil, our risk range continues to be, intermediate term risk range, continues to be 65 to 85. Now again, if you want to get specific on the immediate term, it's much tighter. Immediate term trade range on WTI is 79.79 to 81.94. So again, oil's going to get overbought, and then it's going to go back to making lower lows. As oil makes lower lows, energy stocks make lower lows. It's really simple. So again, watch the flow through. It's called quad 4 deflation. When you have deflation like this, the weakness is pervasive and the bounces are skinny. So again, that's what's happening in oil right here now. If you're looking for a risk range on gold, 1221 to 1251, much less volatility there. Again, if you want to be long gold against short oil, we would do that all day long. If you want to be long gold against copper, we would do that all day long. And shorting copper right here now is what I said in the top 3 things. Looking at the risk range on the 10-year bond yield, the current risk range is 212, 2.12 on the 10-year. On the low end, and the high end's 2.31. So again, if you're trading TLT or EDV or any bond, and again, if you're long bonds, you've had a much less volatile life than most people that are trying to storytell their way around equities. You would say, wow, okay, when we're right around 231 on the 10-year bond yield, I buy more TLT, or I buy more EDV, which is a 20 to 30-year strip. So again, that's what we like. That's the low volatility life that we live here at Hedgeye. We like to buy the bonds on the pullback. So today you see what, 228 on your screen? Wait for 231. Get cute. Some people like to be cute. I certainly do. That is what it is. And my wife is saying I'm getting less cute as I get fatter and older. Looking at currencies within the market message, people are saying, well, the euro is going to go to 120. It's not. It didn't. And it's not. 126 to 128 is the risk range on the euro versus the dollar. Why the euro looks better than it did 3 months ago is that the Fed's setting up to get more dovish. So again, they're not going to get dovish most likely at the meeting. If they do, the dollar is going to get slammed. But tomorrow at the meeting is basically the last of the Mohicans. They say, okay, we're done. But then that just opens the door to start getting reopening Pandora's box on what QE could look like next. So again, that's why I don't think the euro is going to 120. That's a very newsy type level, and it is a round number that I don't particularly care about. Looking at everything else in currencies, the yen looks interesting on the long side, which is saying something. I don't know what. Looking at economic data points, just as a friendly reminder, the U.S. economic data points for the month of October are slowing. Now, you've had market PMI, MARKIT kind market PMI readings on both services and manufacturing PMI that have slowed sequentially. That means slowed month over month. So again, the economy is slowing. All of consensus continues to think that GDP growth is going to be something like 3+%. And again, that's wrong. The bond market has it right. If you believe that you want to fade growth, again, you want to be on the short side of growth. You want to be long bonds, and you want to be shorting 6 of the 9 sectors in the S&P that we don't like. Away from that, pretty quiet morning with the exception of the Swedes. The Swedes have cut to 0.00, because they were at 0.25. So I'm sure that's going to create the manifestation and the elixir of life that is central planning, but maybe not. It's interesting, but again, not surprising. After everyone's cut to 0, what is left? 0.
Just what we were looking for.
2 hockey players came to conclude that.
Yeah. We got a lot of action in the queue this morning. First one, do you still agree with Rickard's strong euro call?
No. I mean, well, I think what Rickards was trying to say was that incrementally Draghi knew what he was doing. And he does. I mean, he's the master puppeteer out there, but that doesn't mean that you're going to have a strong euro. I mean, from 140 to 126, I don't think that that's a monumental surprise that we would not be bullish on the euro. When it broke our trend line, which is the key line, 134, we said, look, that's not a long anymore. So again, euro, provided that it's below 132, looks uninteresting to me. The yen looks interesting on the long side versus the dollar. That's relatively new, and there's no fundamental reason to support that other than that the Fed's going to get more dovish on the margin relative to the BOJ, which is, again, how you trade currencies is one relative to the other. So again, you got to say who's going to get more easy next in terms of the most incremental. And I think the Fed is up. The Japanese went first and the Europeans went in the summertime, and now it's the Fed's turn to get easier.
Right. We'll get some read-through on that this week. The next one, your keen intuition on U.S. equity reaction to possible outcomes of tomorrow's FOMC announcement, particularly the small caps.
I mean, it's just the same old. I mean, how many times do you have to let people get out of small caps? I mean, should we make this call every day, every month, not every year, but I mean, look, we're bullish on small caps last year, we're bearish on them this year. On every bounce, no volume bounce, again, volume decelerates on the bounces. What we would say, whether it's the Fed meeting is your catalyst or the sun rising in the east is your catalyst, I mean, that is a selling opportunity. So again, it's the most illiquid, small, mid-cap, and expensive part of the market that we've ever seen. It's trading at 55 times trailing earnings for the Russell 2000, and people can't get out of it. And if you don't believe that, go back to looking at what the market did 2 weeks ago and tell me that that was a market people could get out of. They can't.
Thanks. And then this is a pretty simple one. What are your favorite 3 short stock ideas?
Whew. Preparing me. I mean, a couple good research calls that are top of mind. Because what we like to do is we introduce to the institutional side of our business big short ideas. Now, obviously, we can't sell that to you for $1.99 a month, but the reality is that our analysts make big calls. Twitter was a short call. Kohl's was a short call. Kohl's, I thought, was a fantastic call. Brian McGough made that call. Literally, Citigroup upgraded it right at the top. And this was ahead of the analyst day that a lot of people were saying, well, Kohl's was going to hold the line. Well, they did not. They had to guide down into their analyst day, which to me is just a disaster. The middle part of the economy is a disaster. 2/3 of the country is in recession. They didn't have wage growth, and they're certainly not going to go buy another sweater set at Kohl's today. So again, that's one of the better looking shorts. I don't think you buy Twitter on the drawdown. Again, Twitter missed the core side of their organic business in a big way, and expectations at this point for Twitter are unbelievably high. I mean, if you look at revenue growth at Twitter, it's going to go from over 130% year over year to something closer to 35% next year, which is really our call on Twitter. And then if you look down the line, I mean, CAT is something we've been backing on the short side. We have a lot of shorts. We have 30 to 40 of them. So I don't want to be particular because I might get the analysts upset if I pick one over the other.
I hear it. Yeah, lots of color there. And I'll combine. We have a few energy-related questions here.
Oh, energy shorts look awesome. Kaiser, sorry, I should have given Kaiser Bears shorts should be all the shorts. I mean, any company that trades 5 times levered, 2 times the value of an E&P, an upstream MLP that Kaiser doesn't like, oh, you got to have those on. Those are tasty.
Well, then how about why isn't this disinflation of energy prices from the summer highs good for the consumer?
Well, it's good for the consumer. The problem is that the consumer doesn't just stick a gas pump down his throat and that's all he consumes. I mean, it's a convenient bull case. Don't forget that the bull case used to be that inflation was good. Now deflation is good. So both inflation and deflation are good. Again, they're called permabulls. So again, I don't doubt that at some point for the Walmart customer, lower gas prices are going to be good. The problem is that, again, if you look at the consumer spending basket, and the way that we look at it is the median consumer. So the median consumer, which is not most people on Wall Street, so their average income are around $48,000. Their basket is 17% transportation. But a lot of those people don't have a car. They take the bus. Now, if anyone on this call is taking the bus to work can tell me that they just got a price cut on their bus ticket, let me know. I'm going to take that bus too. But again, what's going on in the rest of the basket, which is more important, is that you're seeing the all-time high in cost of living in this country. The biggest component for the median consumer is called shelter. You know, again, food and shelter are actually the two top things, which is a really primitive comment there, but that's the point. So again, rent is at all-time highs because we reflated the real estate bubble. So again, you'd have to see rent check cuts, Starbucks coffee cuts, cups. All these things have to see price cuts, and they're going to happen on a lag. Oil prices are good, but it's not going to give you kind of the elixir of a performance life on the long side. Consumer discretionary is still one of the worst performing sectors in the marketplace, and we'd argue and have argued that that's an early cycle slowdown look through. Again, that's much more important than oil prices.
Great, thanks, Keith. And we'll go with one more question here. Do you think the massive decline in oil prices will help importer countries with the current account?
Will
This decline in oil prices help net importers with the current account?
Yeah, I mean, it has to alleviate some of the pressures. I mean, think of these poor guys in Japan. I mean, what are the, lower prices, yeah, bring it. But what's it really going to do net? I think that from a stock perspective and a risk management perspective, deflation is a much more important concept that people have to really understand and come to grips with. People really screwed this up in the third and fourth quarter of 2008. People said, wow, I mean, you could have a lot lower oil prices. You could have a lot more benefits from an importer's perspective. There's a lot of good things that happen, but you have to go down perdition's path before you get there. The whole concept of deflation is that the prices actually have to go down first. So again, I'd be much more focused on what does deflation mean for capital markets? What does it do to the capital market buoyancy that we saw at the bubble tops? There's a whole ton of things to think about that are not very good things to be thinking about right here and now, but that's the job of a risk manager.
Right. Thanks, Keith. Thanks, everyone, for tuning in here, and we'll catch you back here tomorrow, same time.